I'm gonna be sharing with you how you can make a ton of money off of the banks. One thing we can bank on is that Americans are going to continue to get into credit card debt. Now, as we all know, credit card debt recently reached over $1 trillion in 2024. Now, this graphic right here shows the change in household debt from Q3 2023 to Q4 2024. Credit card debt had the largest increase of all the different categories. So you have student loans, auto loans, mortgages, credit cards, and others. I wanted to share something with you because on the other side of all this credit card debt are financial institutions having record profits. This is Truist, a top 10 bank in the country. So they were up over 20% in 2024. You hear a lot about all this no-doc funding from Chase, right? They're up 42% over the last year in 2024. Now, this one is pretty shocking. So Bread Financial Holdings, Inc. So they're actually behind Community Bank. So Community Bank is a third-party credit card issuer. Some of y'all might be familiar with some of the cards that they have. They're similar to like Synchrony. They do co-branded cards with retailers. They're up 94% in 2024. 94%. That is insane. All right. You got Synchrony Financial, again, a similar company, up 78% over the past year. Goldman Sachs, a lot of y'all know the Apple Card, all the GM cards, despite all the headlines about them trying to get rid of their credit card portfolios and get out consumer lending, they're up 52% over the last year. So these financial institutions are making so much money off the backs of Americans in record consumer debt. And I'm gonna break down exactly why I think this trend may continue. And again, this is not financial advice, but I just wanted to share some of my hypotheses with you why I think a lot of these banks will continue to perform. You have Bank of America up 34%, not too bad. Wells Fargo up 46.5%. You also have MasterCard up 24%. Visa is up 22%. American Express up 63% over the past year. And I'm going to break down American Express a little bit later on, why they're performing so well. Look at FICO, right? We always talk about FICO Vantage Score. Look at FICO, right? Up 75% over the past year. So their stock price increased over $840 something per share. That is insane. FICO is the premier algorithm that's used for a lot of these credit cards when people are applying. So every time someone's FICO gets pulled, FICO's making money from that. So one thing you could do, again, not financial advice, but we know that consumers are going to continue to spend, continue to get into debt. And so these companies that are around all of this record trillions of dollars in consumer debt are going to continue to make money. That's one thing that you could bank on. You could bank on consumer debt continuing to rise, right? Because it's never really came down. Right here in the blue is housing debt. So that's going to be mortgages. In the red is going to be non-housing debt, right? So this is going to be credit cards, loans, lines of credit, auto loans, student loans. Now, if you notice, like, the gap between those is actually growing over time. So basically what that means is that non-housing debt, again, credit cards, loans, auto loans, are growing at a faster pace. I wanted to share this with you. So this is actually a report from TransUnion, and it shows Q3 2024 credit card trends. First one, number of credit card bank cards, right? So this is going to be personal credit cards, the total number of personal credit cards in Q3 of 2024 at 554 million. A lot of the accumulation of credit cards and debt, that really happened, I would say, prior to the rate hikes in 2022, right? So you could see the growth the number of credit cards is continuing to increase, but the pace in which it's increasing has slowed. So you can see from 2021, again, this is in a low interest rate environment, very low interest rate environment, monetary easing. The banks are just giving out loans, giving out credit cards like candy, right? So we went from 472 million to 510 between 21 and 22. So that was an increase of about, let's say, 38 million credit cards. Then from 22 to 23, it was about, let's say, 27 million increase. And then from 23 to 24, it looks like it was about a little shy of 17 million in credit cards. So the number of bank cards are actually, or the growth, right, So a lot of times with a lot of these statistics, when you read the headlines, they try to manipulate it. So they'll say, oh, credit card growth is slowing. Now, it's not really slowing, but just the pace in which it's increasing, the speed in which credit card origination or credit cards are increasing is slowing down from 21 to 24, but they're still increasing nonetheless, right? A borrower level delinquency rate. So that's still increasing, right? From 1.1% up to 2.43% in Q3 of 2024. Again, it's not large overall, like the majority of consumers are not 90 plus days delinquent, but it is increasing. So this might seem like a small percentage, but when you look at the total number of consumers who have credit cards, it starts to amplify, right? So as the percentages, you got to think the percentage is increasing in the number of individuals and consumers with credit cards is also increasing, right? Every year there's new young people getting credit cards, people getting into the credit space, and a lot of the information out there, people are just more aware of like how to apply for credit cards. You can apply online on your phone. So a lot of people are still continuing to get into debt. Now, this is what we've been talking about as far as the total credit card balances in 2024 surpassed $1 trillion. Average debt per borrower is also increasing. These are a couple different factors, I would say, is why I believe the banks are going to continue to increase in valuation of their stocks and continue to make profits because total credit card balances, it's still increasing. Now, again, it's not increasing as fast as it was when we were in this quantitative easing cycle, right? In 2021, the rate hikes started to hit in 2022 and they were pretty much held steady. So that did to a certain degree, did work as far as curtailing the growth as far as overall credit card balances. But what's happening now in 2024, last fall in September, is when we saw the first rate cut since 2022. So now we're getting back to, I'm not going to say it's an environment of low rates, but the rates have come down. The prime rate has come down. Now I believe that's also going to accelerate more consumer spending, right? Because when they lower rates, they're trying to encourage more economic activities. The banks are going to be throwing more money at people, and people are going to continue to get back in debt. Now, the rates aren't as low as what they were in 2021, right? Because we were during the whole COVID situation. They wanted to stimulate the economy. It's not to that degree, but the fact that rates have been lowered over the past let's say since September, right, over the past 4 or 5 months, that's going to actually, I believe, increase the total credit card balances from 21 to 22 was about $138 billion increase, right? So from Q3 2021 to Q3 2022. Then from Q3 2022 to Q3 2023, it was an increase of $130 billion, right? And then from Q3 2023 to Q3 2024, how many billions is 1.06 trillion? So a trillion is a billion 1,000 times. 0.06 trillion, I believe, is 60 billion. All right. So it increased 65 billion, if my math is correct. Someone please double check me. But nonetheless, the growth in total balances has decreased from 23 to 24 versus, let's say, 22 to 23 and 21 to 22, right? So again, just to point that out, again, average debt per borrower, that is increasing, right? So that's not a good thing. And then we look at the total number of consumers carrying a balance. This is another strong indicator, I believe, why the banks are going to continue to increase in their valuation, right? Because you think about this, 23 to 24, it increased by almost 3 million consumers, right? Let's say 2.8, if my math is right. Yeah, about 2.8 million new consumers are carrying a balance. So 2.8 million consumers who weren't originally carrying balances are now carrying balances. So when you also look at this, average new account credit line, right? So the credit limits, right? So the average credit limit. So you see over time, the credit limits are increasing as an average, right? So that means people have more money or more credit to assume more debt. That's another reason why I think it's going to continue. Now, the other thing I wanted to show you guys, this shows the average balance growth and utilization, and it's disaggregated by the different credit buckets. And also wanted to just point out too that they did color code this. The dark blue is beginning in 2019. Then you have 2020, 21. So it basically goes in order over the last 6 years. So 19, 20, 21, 22, 23, 24. Right here, this shows the utilization, right? So this represents utilization by the different credit buckets. So there's 5 different credit buckets. You have subprime, near prime, prime plus, and super prime. And this actually makes sense when you think about it, right? So this represents utilization. This is crazy because, again, the way to interpret this, as you move to the right from 2021 in the subprime group, the average utilization increased. And it was already in the 80%. 80% basically means like you're close to defaulting, right? They don't have much available credit. So by default, their utilization is more likely to be high because we're talking about people who might have a $500 limit, $1,000 limit. So it doesn't take much to get it 80%. You spend $400 on a $500 credit card, you're at 80%, right? So you can see it's increasing, right? So in 2021, it was at 82% average utilization for subprime credit card holders. And then in 2024, which is the yellow bar, so 2024 represents the yellow bar for each respective credit bucket, they're at 87%. I think American Express is going to continue to see good growth in 2025. The reason why is because American Express caters to a higher end or more of the super prime type of customer. So American Express customers are going to be basically prime plus and super prime. I would say mostly like probably the prime plus and super prime. So these are people who are less likely going to default. There's been so much growth as far as credit information, how to do credit card stacking. You see a lot of this online where people are just getting more educated as far as how to go about obtaining credit. So again, like I said, one thing we could bank on is that consumer debt, credit card debt is not going anywhere. It's not decreasing. 2022, the Fed started to hike interest rates to try to curtail a lot of the economic activity, right? Because the economy was red hot, right? There was a lot of consumer spending back then. People were paying over for cars, paying over for homes. People were just freely spending money. So the economy overheated, inflation spiked. So the Fed wanted to curtail the activity. I really do think that the interest rate hikes did work. But as you guys know, this past fall, we started to see some rate cuts, and it's unknown what types of rate cuts we'll see in 2025. But if there are, as far as these banks and financial institutions are concerned, that's going to actually help them make even more money and have even higher valuations in their stock price. And so American Express is one of these credit card issuers. I think they're going to do well in favorable interest rate environment, a favorable monetary policy, or even in a restrictive one, right? One thought that came to mind is like, what if you took American Express 0% credit card and just bought Amex stock in 2024? So you would have got a year of 0% interest, but the stock valuation would have increased by 62+%. You would have came up. So again, I'm not telling anyone to do that. I would never tell you to use debt to then invest in stocks. But at the same time, that bet would have paid off if you use some sort of leverage to invest in some of these different stocks. Now, again, this is not an investment channel. That's not what I'm saying. But I just wanted to draw that connection between how these banks are profiting off of record consumer debt. There's a saying that your debt is someone else's income. The interest you pay is the profit to the shareholders. Banks, financial institutions, any companies tied around consumer spending are doing extremely well. Now, again, there's other companies that did really well. The S&P 500, I believe, was up 24% in 2024. And for 2 consecutive years, 20% plus 2 consecutive years in a row. So there's other companies, the Amazons, the Nvidias, and all those types of companies that did extremely well in 2024. But I just wanted to draw that connection between record levels of credit card debt and how well these banks have been doing with record credit card debt. So there's 2 sides of it. A lot of the record debt, economic pain a lot of Americans are going through, and banks are pretty much cashing out because of that. So anyways, that's all for today's video. Let me know your comments down below. And until next time, take it easy, and we'll talk to you soon. Peace.